Hello, everyone. I'm Amaury Cifuentes from BlueKey Personal Wealth Planning. I'm with Bruce Konners, CFA and our Chief Investment Officer, to discuss 2015 and 2016 market conditions.
Thanks, Amaury, and welcome everyone to our market review. We're going to take a look at 2015 and 2016. When we set up this webinar several weeks back, we didn't realize that 2016 there'd be so much excitement in the first few weeks, including just even this week. So we hope that this is a timely and informative webinar for everybody. Today is the most difficult day to invest. That was a great quote I read this past weekend in Barron's magazine, and it was said by Thomas Rowe Price, probably better known to most of you as T. Rowe Price, founder of the famous mutual fund firm. So T. Rowe Price would come to the office every single day and basically say the same thing, which was that today is the most difficult day to invest. And I think that quote is pretty timely on today, January 21st, 2016. But Mr. Price, his main point was that every day there is uncertainty in the markets. Every day there are 100 different reasons why you shouldn't invest and stay in cash. But there's one thing that is pretty certain, at least based on history, and that is over time the market will go up. So even though you can find a million reasons not to invest, you really have to take a long-term approach. So let's talk about 2015. To me, these were the big themes during the year. First, the Fed was all over the news. It was on again, off again. Yes, they're going to raise rates. No, we're not going to raise rates. Yes, we're going to raise rates, then they're not. Finally, at the end of the year, and that kind of pattern was really going on for a few years, they finally raised rates by a quarter point. So while the Fed was tightening just a little bit, overseas in Europe and Japan, monetary authorities were actually easing. So the Fed's tightening a little bit. In Europe and Japan, they're doing the opposite. Oil prices started to fall dramatically last year, and also they fell the year before, and that has spilled over into 2016. So we're going to be talking about that a little bit later. But you'll see that the lower oil prices had a huge impact on earnings for the S&P this year. The dollar was higher, and that was also another big headwind for earnings for S&P companies. Basically, as the dollar gets higher, our goods that we produce here in the United States become a little less competitive overseas. It's harder to pick up sales, so that impacted S&P earnings. In the United States and most developing economies, they continue to grow, albeit slowly. But we've been on this slow growth path for several years right now. China also continues to grow, but not at the rapid rate that it has in the past. And of course, there's been a lot of news in China, and we'll be talking about that in a few minutes. 2015 was a year for geopolitical events. There were at least 3 acts of terrorism in the West, 2 in Paris, 1 in the United States. Overall, it was a very difficult year to invest. The total U.S. stock market scratched out a gain of 0.36%. That's with dividends. If you went overseas, the international markets, and I'm looking at the Vanguard Fund, VXUS, was down 4.20%. And the aggregate bond index, which is mainly made up of treasuries, scratched out a gain of about 0.5%. Here is the entire market activity for the year on a chart, and the white line represents the closing price on December 31st, 2014. If you go all the way to the right, you'll see we closed just under where we opened. So the S&P, this is the S&P 500. We're using the SPY index. So the SPY was down 0.81% for the year. If you include dividends, you actually had a gain of 1.27% in the SPY. The red arrows indicate when the Fed was in the news, and we started early on, and they were talking about an interest rate increase. They were looking at a June rate hike, then they backed off. They said it would be in September. Later on, when the market started to fall and everyone thought they would increase rates in September, they decided not to, and they basically said they wouldn't because of international fears, mainly led by what was going on in China. Finally, in December, they decided to have an interest rate hike. So the Fed was in the news constantly. The other big issue is China. Everyone is worried that if growth is lowered in China, that will impact the rest of the globe. So early on, back in April, there was news China lowers its growth target. Then in August, you had this huge sell-off due to global growth fears due to a slower China. They devalued their currency, and that really led to a big 3-4 day sell-off. However, if you panicked out of the markets, you missed a huge fourth quarter when the market rallied back. Also, the green arrow, that shows when there was a junk bond sell-off, and that was pretty much led by the continuing decline in oil. People are worried that high yield, there are going to be many high yield defaults if oil prices don't rebound, and they're worried about a spillover effect from that. Finally, you had the terrorist attacks as indicated by the white arrows. You had one at the beginning of the year and a couple at the end of the year. That really did not impact the market that much. So that was 2015. Here is a periodic table of investment returns. This is by Callan, and it shows different asset classes. So the S&P 500 growth category showed a decent gain of 5.52%. What's interesting, and that was the top performing category, if you go along that top row to the left, you'll see 5.52% was the second lowest return dating back to 1996. Every other year, the top category, would have some really nice returns. But this year, you could only get 5.52%, and that was if you were in the very best category. Most of the categories were negative, except for the S&P 500 and the Barclays bond aggregate. So it was a difficult year to make money. The other good thing about looking at this table, it explains and it shows why you need to be diversified, because while one category might be good one year, the next year it could be at the bottom or somewhere in the middle. Most people are familiar with the Morningstar style boxes. If you're not, we're going to look at the chart over on the left. And the top row would indicate large cap companies, the middle row would be medium cap companies, and the bottom row is small cap companies. So if you look in the quadrant in the upper right, that would be large growth companies. And that was the only place you could get a positive return last year in U.S. equities. Everything else was a sea of red. So if you were diversified at all outside of large growth, you probably had a flat or negative return in 2015. Looking at sectors, and this is a list of the Vanguard sectors, healthcare was the winner. It was up 7.18%, and the losers were energy and materials. Energy was down 23%, materials were down 10%. And material companies would be companies like DuPont, Dow Chemical, PP&G. Overseas, there was really no place to hide. The Pacific area was the only up area. That was plus 2%. International ex-US was minus 4.10%, and emerging markets got hit pretty hard, minus 16%. In bonds, the aggregate bond index, as we already said, was up 0.48% for the year. The big winner was preferreds, plus 8%. And then corporate bonds, especially high yield, was down 5%. Investment grade was down a little bit, minus 1%. Those are two areas that are of concern to us, and we're going to get to them in a few minutes. Here are commodities. Every commodity, if you look in the 2015 column, was negative. So you did not want to be a commodity investor last year. If you look at oil, down, and these are futures contracts, down 30% in 2015, down 45% in 2014. So let's take a look now at 2016. The first thing I want you to remember is to remember the big picture. That the only thing we could say today with somewhat certainty is that over time, if you take a long-term perspective, markets go up. So you're looking at this chart from 1926. If you started with $1 and you invested in large stocks, you got basically a 10.1% return, and it'd be worth $5,317 today. Meanwhile, if you just invested in Treasury bills during that same period, you would have $21 today. So what would you rather have, $5,317 or $21? This chart shows us average intra-year drops, and the average intra-year decline is 14.2%. So pretty much every year you're going to get some kind of decline in the market. It's just part of normal market activity. Coincidentally, from high to low, to yesterday's low, I think we were right about 14-15% for the year. So right now, at least so far, we're right on the average intra-year drop. So now we're going to talk about some of the factors for 2016. Right now, if you look at the total U.S. market, and this is as of the close today, starting from December 31st, the total U.S. stock market, as measured by the VTI, was down about 9%. Overseas, the VX-US was down about 10%. These are the different things that I think are impacting the market. We're going to get into each of them. First, China. Second, the price of oil. Third, we're going to talk about the Fed, their geopolitical events, the U.S. presidential election, the U.S. and world economy. We're going to take a look at a technical analysis of the market, and then valuation. So this is the big question, and this really is what everyone's wondering about, and because it could have a big impact on where the market's going. The question is, are we going to continue on the road of slow to moderate growth, or is the economy about to enter a recession? Is the stock market trying to tell us something that we're headed towards a recession? Why do we want to know if we're going to go in a recession or not? Well, if you look at history, recessions are often associated with pretty big declines. So it's important to know what the economy is going to do. However, if you look at many of the factors that are associated with recessions, such as spike in commodity prices, an aggressive Fed, and extreme valuation, we don't have any of those factors at this time. Let's first talk about China. Here's the concern. If China's growth declines or reverses, it will bring down the rest of the world economy. So manufacturing, there's something called the Purchasers Managers Index, and if it's less than 50, that indicates that the economy is not expanding, it's contracting a little bit. Now remember, this is just for manufacturing. It's not for the entire economy. So this is the Caxton Manufacturing PMI from China, and the last result, which came out January 3rd, came in at 48.2, which was a little bit under the 48.6 and 48.3 from the previous months, but up from the two previous readings prior to that. So the PMI numbers were really no surprise, but the market reacted really negatively when they came out. But if you look at what's been going on, we know that manufacturing in China is slowing a bit. The value of the Chinese currency continues to decline, and the fear here is if it declines a lot more. What would that mean? First, it would mean Chinese imports would drop, so that would hurt the world economy because it would be more expensive for Chinese companies to buy foreign goods. At the same time, and for the same reason, Chinese exports would become more competitive, so that would increase their sales and cut sales elsewhere around the world. And another bigger concern is there's lots of Chinese debt denominated in foreign currencies, including US dollars, so it becomes more difficult to pay if there's a huge drop in the Chinese currency. However, at least for the last couple of weeks, it's the Chinese authorities, I think, are doing a pretty good job of helping the Chinese currency stay somewhat stable. What I think really set off the Chinese sell-off, and if you remember the first week of the year, that was really the big news. When China sold off, that really hit the U.S. markets. I don't think it was the PMI data, and I don't think it was the Chinese currency data. What I think it was the implementation of the circuit breakers in China, which started, I think, on January 4th. They put in a new rule that if the market closes with a 7% drop, the market would be closed for the rest of the day. Now, the Chinese market, by nature, is very volatile, so I think there was almost a rush to the exits when people realized that that rule was in place, and I think that really hurt the Chinese market the first few days. China came out with their GDP numbers just a couple of days ago on Tuesday, and they showed 6.9% growth. A lot of people think those numbers are fudged, but most economists think that the Chinese GDP numbers are more accurately between 3 and 6%. So China is still growing, just not as growing as fast as they have in the past. However, you got to remember they're growing off of a much bigger base. The other thing to remember is that share prices in China matter little to the real Chinese economy, and U.S. sales are only about 1% of U.S. sales are only exposed to China, so it's not a big number for the United States. Going to the next slide, when you look in the middle of this slide, you'll see that China's stock market is only 3% of world's market capitalization. This is a report, came out January 11th from the Organization for Economic Cooperation and Development, and they took a look analyzing what's going on around the world. And if you look at the different regions of the world, pretty much everyone is in stable growth, slow growth, or it's just a stable economy. There's really no signs of recession anywhere around the world. This is from Ned Davis Research, and they looked at the leading indicator numbers, and they're writing here that for the first time in 2 years, the leading indicator numbers have turned up. So they say this likely means a positive turning point in the global economy in the coming months. So they see the world economy improving, not getting worse. Let's talk about oil. Here's the cover of The Economist magazine, drowning in oil. There's just too much oil around, forcing the price of oil way down. This cover, though, was from March 6, 1999. And here are a couple of quotes from that article. "The world is awash with the stuff, and it is likely to remain so." Sounds kind of familiar to today. Here's another. "But low prices will gradually put most such areas out of business, especially if cash-strapped Gulf states conclude that the best way to increase revenue is to boost production, which could drive prices from today's $10 to as little as $5. Sounds exactly like what's going on today, although today the price is $30. But they were worried that prices were going to go to as little as $5, another 50% drop. So let's see what happened. In 2000, just a year later, prices were almost at $30 a share. So they increased by a factor of 3. 2005, they're at 50. 2010, $71. So I'm not saying that's going to happen now, but a lot of times when you think that things are just going to stay low forever, sometimes you're surprised to the upside. So what is the concern? Why do we care if prices go lower? First, it might lead to a tidal wave of bankruptcies with all the oil exploration and shale production done in the United States. That would mean defaults on lots of high-yield debt. Energy issues were yielding a record high of 17.43% as of Friday. It would mean lower overall earnings for U.S. companies. If you look at the price of crude in the chart on the right, this is the February 2016 futures contract, started at $65, was down to $29 as of the other day. The other thing that people are worried about is, what does it mean? What is oil trying to tell us with a lower price? There's some arguments that it means there's lower demand out there. And if there's lower demand, that means we might be going into a recession. It means things are slowing down. However, if you look at the chart in the bottom right, you could look at the light blue line. That indicates supply, and the darker line under it is demand. And you'll see that demand has slowly been going up, but supply has been going up quicker. So to me, this is more of a supply issue than it is a demand issue. And this is from the U.S. Energy Information Administration, and they're projecting that by 2017 the market will be more in sync. So if oil prices decline, this is really what the big fear is, that there's going to be a huge wave of defaults, and that default is going to spill over into the regular high-yield market and maybe even the investment-grade market. Guggenheim came out with a report just the other day, and this is what they wrote. A spillover into other areas of the credit markets is inevitable when short-term investors attempt to liquidate credit positions over a short period of time, particularly when a secondary market liquidity is thin. However, a genuine turning point in credit will not be reached until a U.S. recession looms, and underlying corporate fundamentals no longer support a low default environment, neither of which is true heading into 2016. So what that means to me is that if there is a lot of defaults, is it might spill over a little bit into the secondary markets, mainly because there's not much liquidity, but there won't be lots of defaults throughout the remainder of the high yield market. This chart is really interesting. This is a year-by-year look at different sectors of the S&P 500 and how much they contribute to earnings. So if you go to the bottom where I just put the star, the blue area, you'll see this is the contribution from energy. And in 2014, energy added $19 to S&P 500 earnings. In 2015, it dropped to about $3. So the S&P took a hit of almost $16. And yet, earnings for the S&P declined a little, but not much. So even with that huge hit from energy, and even with the hit from a higher U.S. dollar, you know, the S&P companies have been doing pretty well, and they managed to have roughly stable earnings. So I think that's a good sign. Let's talk about the Fed on December 16th. You'll see over on the right, the Fed increased rates by 1/4 point, which really is not much, but I guess it does have some kind of psychological impact. The concern is how aggressive is the Fed going to be? So in the past, if you look at history, when the Fed has raised rates in a fast cycle, and that basically means 4 times a year every time they meet, the median return has been negative 2.7%. But the return has been a positive, an average of 10.8% when the Fed raises rates in a slow cycle. So what do we think they're going to do? I think the Fed is going to be very careful and very slow about raising rates. I don't anticipate more than 1 or 2 increases this year at most. The risk, though, is if inflation accelerates, and that forces the Fed to move faster. Geopolitical events are a wild card that we have to keep an eye on, but practically speaking, their impact has been minimal, both in terms of return and also in the number of days to recover. But already this year, there's been terrorism around the world. At Saudi Arabia and Iran were all upset at each other over the execution of a cleric in Saudi Arabia. North Korea tested a nuclear device, you know, and then there's always the unknown that's out there in the future. The presidential election is also a huge wild card. I'm not really going to comment on the individual candidates, but you have guys and women on both sides who really have some unusual policies that they're proposing that, you know, possibly could be dangerous for the market and the entire economy. Conditions that often precede a recession, and to me this is why we're not going into recession, at least in the near term. These are 5 factors that often are associated with a recession. First, is there accelerating inflation? You look at the graph on the bottom left and you see that inflation has been declining, not accelerating. Do we have an inverted yield curve? No, we don't. The 30-year interest rate, the 20-year, and the 10-year interest rate are higher than the 5-year, the 1-year, 6-month. So an inverted yield curve, it would be the opposite. The short term would have higher interest rates than the long term. We do have a rising inventory to sales ratio, and this is the only factor that would favor a recession at this time. And the big thing, the employment numbers have really been good. This is the monthly change in non-farm payrolls. This is really a coincident indicator with recessions, but you can clearly see in the shaded areas that monthly change in non-farm payrolls is negative when we're in a recession. And right now, if you look all the way to the right, it's been positive. Construction numbers have been really good. These numbers just came out yesterday. And you look to the right, and pretty much everything is up. This is from Fidelity, and if you look at S&P 500 profit margins, excluding energy, they're still rising slowly. So to Fidelity, this means we're in the middle of a cycle, not the end of a cycle. You look down on the bottom left, and you'll see that labor markets are getting tighter, and real wages are going up. So these are not signs you would see at the beginning of a recession. Small businesses, more than 15% are now planning to increase wages. And initial unemployment claims are declining. Again, these are not signs you see entering a recession. If energy prices do stabilize or even go up, that will impact inflation a little bit. And historically, at the end of a cycle, what you see are higher wages and higher commodity prices. So right now, we might be at the beginning of seeing a little bit higher wages, but we're nowhere close to seeing higher commodity prices, at least right now. And that has been an indication of a late cycle. So we don't think we're there yet. This was in today's Wall Street Journal, and this is showing in the upper part of the graph that equity prices have been going down around the world. But if you look at purchaser-manager indexes from around the world, they're all north of 50, which is showing an expansion around the world. This is from the Atlanta Fed. This came out, I think, just yesterday. And the Atlanta Fed, and if that's the green line, you look at their GDP forecast. What they're doing here, it's kind of a minute-by-minute forecast almost of the gross domestic product. They are below the blue chip consensus, but they're still showing growth. And if you look at the last reading, it showed an uptick a little bit north of 0.5%. The U.S. dollar last year was a big headwind. You could see the increase from 2014 through 2015. It was up about 25%. That made U.S. goods much harder to sell overseas, but we think the U.S. dollar has been stabilizing, and that appears to be the case if you look at this graph. And if it can stabilize, that should be another headwind that doesn't exist going into 2016. Volatility is back. We went through a period, if you look in the lower right, where volatility was unusually low. It was basically in the low to mid-teens. This is the VIX index. Now we think that volatility is going to be back into a more normal range of the mid-teens to the low 20s. As of yesterday, volatility, the VIX was at 28, and a lot of times when you see a spike in volatility, that is often associated with the end of a decline. Might just be a short-term decline, but if you look at 28 based on history, that's pretty far up there. Here are some anecdotal signs of a possible recession. Rail car loadings dropped by at least 5%. Spreads in the junk bond market have been widening, indicating a 44% chance of recession. You see some chains like Macy's and Walmart announcing recent store closings. Mike Jackson, the CEO of AutoNation the other day, said that fourth quarter sales was more push than pull. And what he meant by that is they had a push to get sales by having higher sales incentives, those kind of things. So he thinks auto dealers are going to have significant margin declines, and people who took out car loans at the end of the year, at the beginning of the year, 2.6%, are already a little bit behind. So that's a negative sign. So you can always find these kind of negative factors. These are just some of them that are out there. I'm trying to give you an indication of what's going on in the real economy. This is a chart that I don't like. It shows a 60% basis point decline in profit margins. Has pretty much always predicted a recession, either coincidentally or in the future. And again, these profit margins are pretty much down because of what's going on in the oil markets with energy companies and also the U.S. dollar. So hopefully this will be another exception like 1985, but it's something we need to keep an eye out for. Let's look at what technicians are looking at. A lot of technicians are bearish on the market. Here's one reason. You see that trend line that's going up, and that was broken a few months ago. Right now, we seem to be at support at about that 185 level. It hasn't cracked that yet. That's good. And then if you look at the two indicators on the bottom, the MACD stands for moving average convergence, divergence. And in the past, when it's gone less than zero, that has the market has declined. However, if you also look at this, you'll see a bunch of false signals at the same time. Same with the volume zone oscillator. If you remember from finance class, you probably learned the efficient market hypothesis. and you learn that markets are weak form efficient. And what that basically means is that looking at tables like this, at graphs like this, at charts like this, does not give you any kind of edge in the market. So I'm not sure I completely believe that. A lot of people do look at these charts and do make investments based on it, but that's what the hypothesis says. Sentiment is really, really negative, and that's a good sign for the markets. The last time it was this negative was April of 2005. This is from the American Association of Individual Investors. And if you look at the performance of the S&P 500 6 months later, only one time was there a negative return, and that was in January of 2008. Valuation, you can make arguments up or down that the market is overvalued, the market is fairly valued, or the market is negatively valued. Really depends if you take into account interest rates or not. If you look at forward earnings, we're at about 16 times, and you see that we're kind of in the zone of fair valuation. So my opinion is that since interest rates are so low, which means there really aren't any good alternative investments out there, that the markets are fairly valued, and if earnings can increase, the markets can move north from here. This is back in May. This is a quote from Warren Buffett, but I think it pretty much summarizes it. He says the market, based on normal interest rates, and this is when the market was priced higher, is on the high side of valuation, not dangerously high, but on the high side of valuation. On the other hand, if these interest rates were to continue for 10 years, stocks would be extremely cheap right now. This is an article that came out the other day, an interview with Abby Joseph Cohen from Bloomberg. And Goldman, she's from Goldman Sachs. Goldman Sachs is basically saying the fair value for the S&P is 2,100. Also, Cohen is saying that what we saw so far this month has pretty much been an emotional response, not based at underlying factors. So in summary, this is where we're at. We've had about a 15% drop from the very top in May to yesterday's low. But long-term expected returns are now higher than they were back in May. I mean, that makes sense. As the market drops, if you look at your expected return over time in the future, it's just gone up. So the market has become a better buy, even though it's probably more difficult to buy today than when the market was going up. So far, the drop is in line with the average intra-year drop of about 14.2%. We think that China is still growing slowly, not as fast as it has in the past, but we do believe it's growing slowly. We'll keep an eye on it. And remember, it's growing from a bigger base. The decline in the price of oil is definitely cause for concern, and we have to see how that's going to spill over into the rest of the credit markets. The U.S. economy, at least right now, based on the weight of the evidence, we don't think it's going into a recession, but it's something we need to watch. If it does go into a recession, that would indicate that markets are going to go down further. We think that we're in a zone of fair valuation. Interest rates are going to continue to remain low. We don't see many increases by the Fed this year, maybe one, maybe two. So there really aren't any good alternative investments. Earnings should increase this year, especially if oil can stabilize and the U.S. dollar can stabilize. So there's a range of possible outcomes with the market. If we do go into a recession, and we don't think that chance is that great, although it does exist, the markets will go down further. If we go into a bear market without a recession, then we might drop another 5–10%. No one knows for sure. But if we avoid recession, we think there's a good chance that we could see some kind of advance going forward from this point. So if you have any questions, please contact us. You can contact Amari, Robert, or myself at any time. You can reach us at the number above or just send us an email. We want to thank you very much for joining us on this market call, and we're going to try and do this in the future. Thank you very much, everyone. Have a great evening.